Okay, so this is my second bit of an update on the financial side with the coronavirus pandemic that is happening at the moment. It's the 21st of March, and so that's where we are at this point in time. I got a lot of feedback post my last one, positive feedback on that, so I appreciate that. If there's anything specific people want me to start covering, please let me know. I'll try and keep this one shorter, but I've got a bit of an outline, and I think it could take a bit of time. But I basically want to cover off on these specific areas, what the current position is, what a recession is, in brief, what the likely course of action is going to be, I feel, in America and Australia. Last week, I tried to step away from what the health side was going to be and how it unfold. I actually want to talk a little bit more about that this week because I do feel it is relevant, because depending on the course of action of Australia and America, there will be flow-on effects, I feel, economically, and so we need to factor that in. The positive side of what can happen and what will come out, aside from an economic side. And then a little bit about the market and what to do with portfolios or how to start thinking about them, allocating additional money, and just generally some context about those sorts of things. So I will start first off with what I feel like the most likely progression is in the health situation, or how Australia is going to come through this time. And I'm quite pessimistic at this point in time. I feel like Australia has dropped the ball a little bit with some regulations that are coming in, and we are much more headed down the Europe sort of scenario, hopefully not Italy, and how that will work. But certainly if I had to say, are we going to be contained or uncontained, it appears to me that it will get through the community. It's already in the community, and it's going to be quite severe. And then we've got the flow-on effect in the health system and economic impact on that. And so we do actually have a blueprint on how to contain it. So South Korea, China, Singapore, they have done it extremely well. So the techniques, I don't know, there may be some humanitarian concerns or those sorts of things about some of those things as well. But the fact is that they've managed to stop it, and they're getting declines in China. There's some early signs of what treatment options there are, and our clients that are in the health space appear to be reading a lot of the literature that's coming out, and so that they would be across some of those things, but it's still sort of green shoots as far as that goes. The crisis really now has moved to Europe. Europe is the centre of the crisis, and Italy is to give you some context, 3 weeks ago they had a similar number of cases that we have today, and now the death toll there is 4,000, with sort of 600 odd overnight. Earlier in the week it was 400 per day, and so those worst fears about the issues that came out a couple of weeks ago in Italy, the type of medicine that they need to be practicing, who actually gets treatment, the wartime protocols that have been implemented, we are starting to see the flow-on effect of that. So just to give you a bit of an idea, okay, well, I think we're all in sort of our own little bubbles, and the medical clients we have given us a bit of their spiel. People that I know in Singapore, investment managers, traders, they've said Australia has absolutely no idea what's coming. And I think, this was summed up pretty well overnight with the coronavirus, potentially getting to the community now. And, I think it is in the community. And so yesterday, which is Friday, at 7 o'clock, this is Bondi Beach. So we're supposed to be apparently socially isolating. People are consistently starting to work from home. And so this is a picture. I spoke to my mother who lives in the northern beaches of Sydney, and Manly was exactly the same. Restaurants overflowing, cafes overflowing. So to feel like Australia is ready, specifically individually, mostly I feel that the majority of the population are just still in the what's the big deal, and they're not registering or computing the information that's coming out from the rest of the world about the day-to-day impact that this can be. And so the day-to-day impact is deaths of people that you know, and also complete lockdown. And so I feel like we're on track for a complete lockdown, certainly in parts of Australia. And you know, I may be proven wrong, but that's my feel about where we are going. And so I need to have a bit of a feel to give you the economic side as well. So I think America is worse than Australia. I think the reality is it's probably been in that community before they started testing people. It has been spreading, and it probably is absolutely uncontrolled at this point in time. So that is all sort of the bad news to start with. The good news is that there is like a couple of things. You know, it will pass through time. So we know that there is going to be a solution at some point in time. There has been a blueprint about how things can work and the way that things should happen. Whether that gets implemented or not is questionable. And the third thing, I think, and this is less from the health side, but on the economic side, is that through the world, governments are going to do absolutely everything they possibly can to the extent that they would rather send themselves broke to keep the economies going or to get the economies growing. And so we can look at different crises through time. We had the Great Depression. The Great Depression really was the position of the government spent nothing. And so there was no stimulus there. And so that made it longer and deeper. And so it's very clear now that governments will do everything. And this isn't necessarily interest rate cuts, because interest rate cuts are gone. There's no impact on that. There hasn't really been any economic impact on that for some time, and it's been a very poor policy, if you ask me. But basically, we're going to get government spending left, right and centre to try and stimulate the economy, borrow, beg and steal to get the economy going. So that is on the positive side. And so we go, okay, if we can look through this time, we will come out the other side. And it's how deep it goes and how long it is to recover. And so I feel like the likely economic recovery will be faster than we potentially could have previously anticipated, because the governments are going to spend just beyond measures than we could have ever expected. So the question then goes, just to be honest, is they're going to go so deep on this that there's nothing coming in any future crises. And I think that is an important thing to remember when we're looking at investment decisions into the future, okay, and how we're putting together money. So that's a little bit on the economic side. We should definitely prepare yourself for this recession word. Australia hasn't had recession for, I think it's like 27 years, certainly before I've been working. So the last recession was the recession we had to have, and that was sort of like 1993 with Paul Keating. So what is an actual recession? A recession just means that economic or growth goes backwards for 2 consecutive quarters. So that means 3-month periods. If we put 2 of them together, we get negative growth, then that is a recession. So people are scared on a recession. It is inevitable that the world is going to go into recession. So prepare yourself for that. What does it actually look like? Well, it's looked like all different types of things in the past. Why is it different this time? Because the government are going to spend like buggery to try and get us out of it quickly. And I feel like life will, there will be economic loss. Like companies like Myer, I see no way that they can survive. And I'm sure they'll be survived in 12 months. I look like a fool. But to me, they're on economic support prior to this. And then put this in there, lockdowns, unless they're getting, compensation from their landlords and things like that, it's just not going to, there's no way that they're going to be able to survive through this without raising external capital and things like that. So a lot of small businesses are already being affected. They will continue to be affected, and that is where the government has put their stimulus, and that to me seems like it makes the most sense at this point in time. So a recession in the past, what does it look like? A bad recession is people lose jobs, people start foreclosing on their houses, these sorts of things. We're so deep into our cycle that banks are going to do everything they can to not foreclose on houses. They've already come out with 6 months interest free on interest rates. That's just the beginning. If that gets us not 6 months interest free, 6 months deferral of interest rates. So if you can't afford to pay your mortgage for 6 months, that is okay. And that's the start, right? And so if this goes for a longer period of time, they will continue that on. Now, why? Because they are so highly leveraged that they need the property market to come through this in some sort of fashion for their businesses to survive. And so they will be backed by the government to put all sorts of things in place to make sure that happens. Now, that really is the extent. So people will lose their jobs, people will, but when things get going again, people will be redeployed. But if people are worried about losing their jobs, they're not going to spend money. So that's a little bit about a recession. I'm happy to talk, more about that, but I think people are have enough of an overview from a high level. To give a bit of perspective on the market, this is a graph or chart that's been going around a little bit. And so this is all the bear markets. All a bear market is a 20% fall in the Australian Stock Exchange or any stock exchange. And then this here is trying to show this is how many weeks into a bear market. So this is the fastest bear market we have ever had. So this is the sharpest rate of fall of shares ever. Even 1987 when people jumped out of windows and those sorts of things. So it is absolutely the fastest, and we're sort of 4 weeks into this, thereabouts. So people are going, oh, it's so steep. I tend to think that to me, and this is the average, but to me, what I tend to focus or think about on that, and here's a couple of steep ones that's recovered out. So where it stops, it starts recovering. So to me, this isn't over, is what I would suggest. And I think it can get deeper. We're off 35% now. This chart was earlier in the week, so so it's actually here. Okay, so at the end of the week, this is where we are. And so, if we go back and look through the worst times in the last 100 years, there's only been 3 times, 80, 82, 07, 09, and 74, we've got to 50%. And so I feel like, we're in the spot at some point that, I do think there's a significant fall under the market at 50%. If the market is off 50%, you are in a 100-year event. And you should be deploying capital or holding on to what you have. So as far as that goes, I think that is interesting. But I think there is a little bit more downside still from here, and patience is a virtue. The other sort of thing I'm thinking on here is there's not enough pain. I remember here in 2007-09, I wasn't around for any of these other ones, but 07-09, people were genuinely fearful, and they, there was so much pessimism around. So people are, and when I mean fearful on the economic side. So people really aren't fearful yet. People are saying, it'll recover, things will be okay, those types of things still. So when it gets to the next level, I feel like it'll be, this is going to cause huge issues. No one can see what's coming, those sorts of things. When people are talking on the economic side, not just the health side, that'll be a very clear indication that we are close or at the bottom. So that gives you a bit of context about where we are with the market, what to do and how to think about things. So I probably should have started with this. But, I used this example last week on basically this Van Eck equal weighted ETF. And the reason I just picked this is because it's a broad exposure, sort of the top 75 odd companies, or here you go, 60 of the largest, most liquid ASX listed companies. It's a broad exposure. And so it gives us a feel about the entire market, and it's just weighted equally instead of having half the portfolio in banks, okay? Interestingly, banks are off 60%. Every bank is off 60% since their highs, except CBA, which is off a little bit less. So, if I think about this market weighted index, what is it yielding at the moment? It's yielding 5.52. There's a franking credit on there. So if I go, okay, well, let's start thinking about this. If I go 5.52 with the franking credit, I'm going to say, let's assume dividends get cut by 30%. If that happens, the yield you can get on that, or the yield you will get on that, is 4.55%. I went through last week on the Peter Thornhill that yields, how sustainable they are, how they will, they're very robust through time, and how companies think about them. No one actually hit me up for a book. I have 5 that I ordered in case somebody wants one. So if somebody wants one of those books, hit me up and I'll send it out. But so what I've tried to do is go, okay, well, if we just get back to where we are now, we're at 35% off. So that is trading at $21.20 at the moment. It was $32.72 4 or 5 weeks ago. So if it gets back to where it is, or where it was, I should say, that's nearly a 60% return to recovery. So it's a 54% return in a capital. And if we say it takes 1 year for that to happen, they go 54% capital plus the dividend that you're going to get, that's a 59% return in 1 year. And so I've kind of done that for how long it takes to get back: 1 year, 2 year, 3 year, 4 year, 5 year. Pick how pessimistic you are. If you're thinking 7 years back to recovery from where we are now, or if you deploy money, it takes that long, then if it gets back just to where it is, your portfolio will generate 8 plus 4.55, which is going to be 12.5% per annum over those 7 years. So that is year in, year out. So this here, I've put in a graphical sort of representation. So if it's just 1, you're going to get nearly a 60% return straight away, 32% each of those years for 2 years, 23 for 3 years, and you get the opinion, or you get the gist of it over a 4, 5, 6, 7 year. I just said, what happens if it gets to a 50% fall? And so every fall from here, if you deploy more money, then you will get a better return. I'm not suggesting that we all wait until a 50% return. I'm not suggesting that we get our money out and wait and hope that it goes down to 50%. But to give you some perspective on this, and this is also, would have been a good thing to preface it up the top. You need to think about the money you have now like this. So your options are sell, sit in cash, and see what happens. Cash gives us basically zero. So that is an atrocious investment. If I could say, if you can just see that civilization will get back to where it is in 7 years' time, that's an implied return of 12% year in, year out over the next 7 years. I think that's a pretty good bet. I think, like, if you can't think that it's going to get back there in 7 years' time, that's a long time from now. Think about what you were doing 7 years ago. Then, I think you're being overly pessimistic. And so to me, on the money that you have there available, I'm still a believer that it's going to recover because of all that stuff that I said before. And but if it takes a long time to recover, it's going to be a lot better than alternative investments about what you have now. And that is the way you should think about it now. Should you put more money in? If you can, yes. I don't feel like you should be rushing at it at the moment. So if it comes off 50%, then what would that imply? And you can see that, how much it magnifies those returns. If it gets back within 1 year, if it comes off 50, I can't see it getting back within 1 year, but it's 105% in that 12 months. 2 years, 55. 3 years, 38. This is each year, 40% return on your money for 3 years in a row. You'd be very happy with that. 4 years, 5 years, 6 years, 7 years. And that's, again, the way you should think about your money if it gets down to 50%, and also the way you should think about money if you're deploying it. So that's, I hope to give you some context on that. Last week I said I felt like it could go lower. If you wanted to put more money in, do it slowly. And I've been talking to a few clients on that. Please contact me if you want to talk about your scenario and how things are working. regular investment plans should be increased, those sorts of things. I still feel there is no rush that you need to be doing it, but you should have your plan. You should know what to do. And so that's the major things that I want to go over. I'll do another one next week or the end of next week. The couple of things that, I think if you talk to great investors, or maybe not talk, but read what they say, they say really markets, the time to be greedy is when people are fearful. And I think people are fearful now. They're not as fearful as they could be. And the market really is a mechanism of transferring money to people that have no patience to people that have patience. And so through this time, maintaining your exposures and potentially increasing your exposures will yield you very good returns from here over your investment time frame. So that is my wrap up. Questions, shoot out to me if you want me to cover specific topics next week. I will do that as well. But, of course, on your individual circumstances, get in touch with me and we will go through those things as well. So I hope that is helpful. And I hope everybody good. I wish everybody good health through this next period of time, and the people that are on the front line and that are going to get on the front line. I thank you from everybody for what you're going to do at this specific time. At this moment, it does really feel like this will be one of the battles of our generation.